Hey there, everyone. Dave Keller here with Market Misbehavior with the fourth video in our series called The 4 Deadly Sins of Investors. If you're just starting here, stop. Go back to the first one because the other three are pretty awesome. We've been talking about the 4 deadly sins for investors: buying too early, buying too late, selling too early, and today we will talk about the fourth one, selling too late. And this one is tough because this one involves holding on to a position after it really starts to impact our portfolio. Some of the other sins are not as expensive. This is probably the most expensive of the 4 deadly sins because it's where the portfolio losses really start to get magnified. As with the previous 3 deadly sins, we will report on what it is. We'll show you some examples of how it actually can play out on the charts. We'll talk about the behavioral bias or biases that is basically causing us to make that mistake in our investing. And then some of the technical analysis tools or techniques that I've used to address those in my own process. And over the course of these 4 videos that I hope you've enjoyed, I hope it makes you think about these different parts of your process. I hope it helps you key in on 1 or 2 of these that you could probably focus your time and attention on, maybe the 1 or 2 that are affecting you the most recently, and then really dig into how we can improve our decision making and hopefully use some of the examples that I'm sharing with you of the different technical tools to incorporate into your own decision making process. Once we get back from vacation and once we get our daily market recap show back up and running, I hope you'll tune in regularly because we will be reporting, as always, on charts that are in these different phases and hopefully help you minimize some of these biases and some of these deadly sins in your own process. So the fourth one, the one we're going to talk about today, is called selling too late. And this is a painful one, again, a very expensive one, because what happens here is, and again, I encourage you to acknowledge if this has happened in your own process. You have a stock that's been working. You have a chart that's doing really well. It feels like your best position. You feel like a rock star trading genius because you have this position in your portfolio. Then the thing starts to top out, and then it starts to go down. And instead of selling it like you probably know you should, you sort of dig in your heels, you hold on to it, and then as the price continues to deteriorate, you start to hold tighter and tighter. You start white-knuckling this position, and then eventually you've done a real issue, which is you've let your losing trades become your investments. And this is not what we wanted to do, right? I have learned that what's important is to acknowledge when the chart is no longer working for us, right? Acknowledging when something's no longer adding value to our portfolio. Now, the behavioral bias, and there are a couple that I think this is that fuel this particular deadly sin, but the one that I think is most common is what's called the endowment effect or endowment bias. And here's what it is. Basically, and to summarize, you basically have an emotional attachment to that particular position, particularly a stock that's been working so well for you. We often become very proud about these positions. We brag about them to our friends at a cocktail party, on social media, whatever we do, and we feel so good. And all of a sudden, we become emotionally tied to this idea of, I'm the rock star that picked this stock that is now the best trade ever. And then what happens is, as the evidence shifts and as the evidence, probably if you had a clear head, as the evidence clearly is pointing against that trade, you still hold on to it. And what's happening is you're now ignoring the evidence and you're holding the position because of your emotional attachment. What I always talk to people about is evidence over emotion. We don't want an emotion-based investment process. We want an evidence-based investment process. In that third deadly sin, which was buying or selling too early, we talked about being a trend follower. We talked about having a regular process of making sure that our positions were still in an accumulation phase, still in an uptrend, because that's an important way of sticking with charts as long as possible, as long as they're still working. But what happens when the chart's no longer working for us? That's where we also have to have a good market awareness or good situational awareness to recognize when the evidence has changed and when the charts shift. And again, our emotional attachment to the position, the endowment bias, is what gets us into trouble. So how do we fight that? Well, we just need a systematic process for reevaluating our current positions and determining when are they no longer working for us, right? When are they no longer doing what we need them to do? The chart of Chipotle Mexican Grill is obviously the burrito company. I think is a great example of some of the common ways that we can recognize when a chart is no longer working. And there are a number of times on this chart where the price was in a clear uptrend. And then there are a number of times on this chart where that uptrend is no longer in play. For example, summer of 2024, the stock was in a primary uptrend, or what we call an accumulation phase. Checks all the boxes that we talked about in a previous video. Above moving averages that are all sloping higher. RSI is bullish because the momentum is strong. RSI is generally above 50. The relative strength is positive. Stock's outperforming. Now, in June and July of 2024, literally every one of those three things that I just mentioned completely changed. The stock went from being above an upward sloping 50-day moving average to being below a downward sloping 50-day moving average. The RSI went from being mostly above 50 to mostly below 50 as the downward pressure started to build, and there was more negative momentum than positive momentum. And because of those trend deterioration factors, the relative performance started to deteriorate. The stock started to underperform its peers. So literally what we need to do to fight this endowment effect or fight this emotional connection is to focus more on the evidence and watch for breakdown scenarios. Watch for stocks that are making new 3-month lows. Watch for stocks that are breaking key moving average support. Watch for stocks where the RSI is starting to break below 50 and break below 40. Watch for stocks we own where the relative performance is turning lower. I don't think this is about predicting the future. I think this is having a regular process of just making sure that the stocks and ETFs you own still are the names that you should own. And if not, let's get out of the way. Let's get them out of our portfolio. More recently, and you can see this is through mid-February when I'm taking this particular example, but look here, Chipotle broke below the 200-day moving average, which for me is a big red flag, right? When I have charts in my portfolio and they break below the 200-day, that is a big-time gut check to say, is this still a stock that deserves a place in my portfolio? But after that, we kind of hung around a little while. Then we made new 3-month lows. And I often look for stocks that I am invested in or that I'm looking at that make new 3-month lows. And that's generally a list I try to avoid because that tells me we might be entering a new distribution phase. And I'm going to wait until we start to show signs of accumulation again. That tells me to probably get out of the way or be underweight or lightening up my position. So for me, this is having clear levels, clear lines in the sand, clear signals we're monitoring for regularly to look for stocks that are starting to break down. And if I own stocks that are breaking below moving average support, making new 3-month lows, RSI below 50, relative performance going down, I'm not doing a very good job trying to own strong performers. Now, there are a number of things I can refer to, stories to sort of reflect on how this has come into my own process. One of the things I'll tell you is my former boss at Fidelity used to say, it's okay to be wrong, it's not okay to stay wrong. And that is a phrase that we've thrown around on the hiking trail. This is actually my family on a hike around Mount Hood. On the left side, that is us on a snowshoe trail with Mount Hood in the background. It was a beautiful day. It was kind of cold and the conditions were a little rough, but it was an awesome hike and a great view at the peak. On the right side, this is us hiking along the Columbia River Gorge. You can't tell, there's a pretty steep drop from this sort of precarious trail down to the river, but that's Washington on the right and Oregon on the left. It's a really beautiful region, sort of all along the Columbia River. And there's some great hiking along there. We spent a lot of times hiking, doing day hikes, far and farther away from civilization out into the wilds. And one of the things that we have learned is you have to have a good read on where you're at all times. So we usually plan our hike ahead of time. We don't just kind of get on the trail and see what happens. We use All Trails, which is an app that we just have available, and we, download the maps ahead of time. We sort of sketch out what we're probably going to do, and then we watch that map. One of us is always watching the All Trails to make sure that the trail we're on is the trail we thought we were going to be on. And it actually has some built-in capabilities now to give you an alert if you start drifting off of your expected trail. But by doing that, right, by focusing on that, by planning ahead of time, and by documenting where we're at, we minimize the problems. Because what happens is if you get off the trail and then you stay off the trail, that's where a small mistake can become a very big and very costly mistake, right? Because if you get further and further away from where you need to be, that all of a sudden can obviously cause a lot of issues. So it's not about being wrong, right? We're going to be wrong. We're going to take the wrong trail, and Lord knows that happens to all of us. And my family we'll be talking, we'll be distracted, and then all of a sudden you wander off, and then it's like, oh, hold on a second, this doesn't look right. And we look at the map, we're like, oh, nope, we made a wrong turn. Let's backtrack half a mile. We'll go back to that fork and take the other one, and we can get back in there. So making mistakes is part of hiking. It's part of life. It's part of investing. Correcting those mistakes in a timely manner is where we want to focus our attention. I think too often investors want to not make any mistakes. Not going to happen, right? We have to be a little more humble than thinking that's going to be the reality. What we want to do is not stay wrong. It's okay to be wrong. We don't want to stay wrong. So how can we have a better sell discipline and better acknowledge when a position that we hold is no longer working for us? For me, that's partly about having a good process of evaluating, of looking for breakdowns, as I mentioned. But I would say the real magic happens before the trade. Remember with the hiking metaphor, we talked about, looking at all trails and kind of sketching out our hike before we get on the trail. It's not like we wait to get on the trail to figure out which path we're going to go. We've planned that out ahead of time. We've downloaded all the maps to our phone. So I think the same sort of way of thinking should be part of our investment process. Our exit strategy should be clearly defined way up front, right up front. As we enter the trade, we're also setting our exit strategy. So this is a, sort of fake page from my very real trading journal. I keep a paper trading journal. And again, I don't care how you do it. You can do it with pencil and paper. You can do it in an Excel spreadsheet. There are plenty of online versions that have been built to try to help you track your trades. For me, the right answer for you is whatever you're going to stick with. So I'm less, dogmatic about the particular medium that you use. It's just have a good process and have a repeatable process. For me, writing 3 lines in pencil in my notebook has served me well for many, many years. I'm not going to change. So here's what it looks like basically when I make a trade. And you probably can't read my horrible to interpret writing, but here's what I do. For every trade, line number 1, what am I doing? I'm buying X number of shares of this stock at this level. Very, very factual. Line number 2, let me summarize my investment thesis briefly. Here's why I'm taking this trade at this particular moment. And there could be a number of factors that I'm thinking about, but what's that main thesis? Let me just summarize it. So months later, when I look back, I go, oh yeah, that's that time I bought Netflix because that thing happened. Oh yeah, and I can look at the chart and remember all of it. So line number 2, why am I doing it? Line number 3 is essential, and that's what would tell me I'm wrong. What would tell me that this position that I took on for this thesis, what would tell me that that thesis is not working? So it's a trailing stop. I will sell when we break X moving average. It might be a particular price level. Usually at the beginning of a trade, at an entry point, I define a very specific price level. If we break below 201.50, whatever that level is, I'm going to sell, or I'm going to sell, take 50% off or whatever it is. But I need to have an exit strategy, and I do it right at the beginning. So part of my process of evaluating the trade is not just making the argument for why I want to buy it. It's also clearly establishing what would tell me that I don't want to own it anymore. And by setting that up right at the beginning, I am much less inclined to get caught up in the emotions later, because if we hit the stop, I just sell it and I don't think about it again because I've already sort of gone through that decision already. Now I'm just taking action on a decision I've already made. You see what we do? So if we find ourselves holding on to things way too long, if you find yourself riding a former winner that becomes a loser, we just need to do a better job defining our exit strategy. And I'll finish off the video just sharing an example from gold. The GLD was one of my biggest positions in 2025. It was certainly one of my more profitable positions because I rode the precious metals trade as gold and especially silver dramatically outperformed the S&P and the NASDAQ in 2025. But I owned a lot of the GLD and IAU during that period, and I did it because the trend was very positive. The challenge as that trend continued was sticking with the uptrend, particularly as it kept going higher. The bigger challenge, I would argue, though, was getting out, because this had become one of my best trades. It was something that had become a larger and larger position. I was super proud of the success of the trade, but then I had to admit that, the trade in gold is no longer working. So I would encourage you, if you've not looked at the chart of gold, look at the chart of the GLD in January, February, and March, and then into April and beyond. Look at all the things that changed. Think about all the things that defined the uptrend. We're above upward sloping moving averages. The momentum is strong. The relative performance is great. This is the performance versus the S&P 500, by the way. And look at how all of that changed, mainly in March, right? All of a sudden, the momentum is nowhere near as strong. All of a sudden, the relative strength started to rotate lower. All of a sudden, we went from being above the moving averages to breaking below them, and the moving averages started to slope downwards. So if you fall victim to this fourth deadly sin of selling too late, I would argue it's about setting your exit strategy way earlier in your process. It's not waiting for the emotions to hit to try to figure out what you're going to do about it. It's having an evidence-based approach and having a clearly defined exit strategy way ahead of time. Also, I would say, as we mentioned earlier in the video, it's having a regular process, right? Routines matter a ton. And I would say with each of these four deadly sins, having a good market awareness, what we call a good situational awareness, is going to help you minimize each of those four. It's certainly going to help you address those. Because this is the fourth video in our series, 4 Deadly Sins for Investors, I would ask you, which of these 4 deadly sins are most painful for you? Make sure you drop a comment below and let me know. I would love to know about your experiences struggling with some of these 4 deadly sins. I hope that this series has helped you think about each of these, maybe help you identify which one of them or one or two of them are most painful for you, and then give you just some initial ideas about how you might address them in your own portfolio and your own trading process. Once we get back from vacation, we'll get our daily market recap show back up and running. I'll look forward to exploring these deadly sins and hopefully helping you minimize them as we continue to identify stocks showing constructive and challenging technical configurations. In the meantime, have a great week. Enjoy it. And remember, it's always a good time to own good charts. Take care, folks.